Folks, we've got a significant situation unfolding that speaks volumes about the shifts in global economic alliances and strategies. Let me tell you, Japan, one of our long-standing allies and a major holder of U.S. Treasuries, is starting to pull back. As of April this year, they've reduced their holdings to a startling low we haven't seen since January 2020, down by 18.5% to just $1.82 trillion. Now you might be wondering, why is Japan pulling out? Here's the scoop. It's all about the money, where it's moving and why. Japan's own government bonds are suddenly looking a lot juicier, thanks to rising yields. What's more, the cost for them to hedge their investments in US dollars has shot up because our Federal Reserve has been hiking up rates to tackle inflation. With the Bank of Japan easing up on their yield curve control, it's like they're rolling out the red carpet for capital to come on back home. Now, let's consider the bigger picture here. If Japan keeps selling off their US Treasuries, what happens? It floods the market with these bonds, potentially driving down prices and bumping up the yields. That might sound good for some, but higher yields mean the US government could face steeper borrowing costs. And with inflation already giving us a tough time, this could add fuel to the fire, potentially nudging our economy towards a recession. And let's not forget the global dance of currencies and markets. A bulk sale of US Treasuries by Japan doesn't just stay in the financial pages, it could whip up a storm in markets worldwide. Think about it. Other investors might get jittery, start selling off too, and before you know it, we've got volatility making waves across the globe. That impacts everyone, from big banks to small investors trying to safeguard their retirement. Moreover, a stronger yen, resulting from capital moving back to Japan, could upset the apple cart in international trade. A pricier yen makes Japanese goods more expensive overseas, which could take a bite out of their export-led economy. So, my fellow Americans, this isn't just a shift in investment from one country to another. It's a clear signal of changing tides in global finance that could affect your job, your mortgage rate, and your buying power. The world of international finance is getting a real shakeup. It's not just about the ups and downs of the stock market or changes in interest rates here at home. There's a bigger game being played on the global stage, and it's called de-dollarization. You see, many countries, not just Japan but also heavy hitters like China, are starting to pull away from relying on the good old US dollar for their international trade and reserves. They're reducing their stacks of US forwards, treasuries, and betting on other assets like gold or different currencies. Why? To dodge the roller coaster of dollar volatility. And get this, the way countries are conducting their international business is changing too. They're sidestepping traditional systems like SWIFT, the big network banks use for global money transfers, and diving into something futuristic, central bank digital currencies or CBDCs. These digital dollars, yens and euros, are set to revolutionize how countries settle up their trade bills, making transactions faster and possibly safer. Now let's rewind and look at Japan. For nearly 3 decades, this economic powerhouse has been stuck in what's called the lost decades. Imagine this. After a wild ride of lending and speculating in the 1980s, the whole thing went bust. Real estate and stock prices crashed when Japan's central bank cranked up interest rates in 1989. And what followed? Years, folks. Years of economic standstill, stagnant wages, lifeless prices, and interest rates that barely twitched. The mess didn't just clear up with a few policy tweaks. Japan struggled with deep-seated issues, like a cozy relationship between its government agencies and big businesses that made bold moves tough. The delay in handling bad loans, over-relying on cutting interest rates, these missteps kept Japan's economy in a lull far longer than anyone wanted. Folks, when we look at Japan's economic story, it's like a roller coaster ride through highs and lows. After World War II, they pulled off what's called the economic miracle, bouncing back from total devastation to become a global powerhouse. But fast forward to the recent decades, and it's a different tale. A tale of struggle against an economic monster called deflation. Deflation, now that's a tricky beast. Imagine your dollar growing in value day by day. Not spending it actually becomes profitable. Sounds good, right? But here's the catch. When people stop spending because they're waiting for prices to drop further, businesses suffer, investments freeze, and the economy just can't get a break. Japan threw everything at it: quantitative easing, negative interest rates, but still, deflation stuck around like a bad cold that wouldn't quit. And let's not forget the demographic angle. Japan's population is getting older, one of the oldest in the world. What does that mean? More people saving for retirement, fewer folks buying stuff. It's simple math: less spending, less economic activity. On top of that, Japan got hit by external shocks like the 1997 Asian financial crisis. Just as they were trying to find their footing, the ground shook again. Plus, a strong yen didn't help matters, making their goods more expensive overseas and hurting their exports. All these factors together, they put a brake on Japan's economic engine, keeping it from revving up into the dynamic growth everyone hoped for. But let's rewind to the brighter days post-World War II. Japan's recovery wasn't just good, it was miraculous. From 1946 to 1954, they rebuilt from ruins. With a little help from Uncle Sam and the demands of the Korean War, Japan's industries like steel and coal roared back to life. This wasn't just recovery, it was a transformation, laying the foundation for Japan to emerge as an industrial titan. So, to all my viewers out there, think about this. Economies are like giant ships. They can turn around, sure, but it takes time, effort, and sometimes a bit of luck. And as we see with Japan, past success doesn't guarantee a smooth ride forever. Let's take a walk through the vibrant history of Japan's economic transformation, which, believe me, is something straight out of a textbook on miracles and muddles. Starting in the mid-1950s, Japan kicked off what's known as the high growth phase, running all the way to the early 1970s. This was a time when Japan wasn't just growing, it was booming. The middle class was expanding, consumer demand was surging, and technological advancements were skyrocketing. The government wasn't just a bystander, it was a key player. Agencies like the Ministry of International Trade and Industry, or ITI, were the architects behind this explosion of growth. They didn't just manage industrial policy, they turbocharged it by bringing in foreign tech and making it better. This period turned Japan into a titan in sectors like automotive and electronics. But what goes up must come down, right? Well, not immediately for Japan. Entering the steady growth phase from 1973 to 1992, even global oil crises couldn't knock Japan off its stride. This era was marked by Japan's uncanny ability to pivot its export strategies, maintaining a gold standard in productivity and efficiency. They didn't just survive, they thrived, cementing their status as a behemoth in high-value industries. However, every story has its twists, and Japan's economic narrative hit a snag in 1992, heralding the onset of what's known today as the lost decades. This wasn't just a slowdown, it was a grinding halt that saw Japan wrestling with deflation, demographic shifts towards an older population, and structural economic issues that seem to cling on stubbornly to this day. So what's the takeaway for us, my fellow Americans? It's a lesson in economic resilience and innovation, but also a cautionary tale of how swiftly economic tides can turn. Japan's journey from a post-war recovery to a global economic powerhouse and then into a phase of prolonged stagnation shows us the importance of adaptability and foresight in policymaking. From 2022 to 2024, Japan has seen some intriguing developments. After years of battling deflation, Japan is experiencing a rebound in inflation, kicked off by global supply chain hiccups and a surge in energy prices. By 2023, these inflationary pressures had grown so intense that the Bank of Japan, BOJ, had to sit up and take action. In a historic move in March 2024, the BOJ said goodbye to its negative interest rate policy and nudged up short-term rates to 0.1%, marking its first rate hike in 17 years. Why this bold step? A significant push from labor unions negotiating for higher wages played a key role. They aimed to boost consumer spending and jumpstart economic growth. This shift signals a broader reevaluation of monetary strategies in response to evolving economic landscapes. While this policy pivot aims to stabilize rising inflation and foster investment, it's not without its hurdles. Increased borrowing costs for businesses could be on the horizon, and let's not overlook the potential ripples from global economic shifts, especially given the dynamics with China, Japan's biggest trading partner. The BOJ is betting on a brighter future, confident that Japan is finally stepping out of the long shadow of deflation thanks to recent wage hikes and a moderate economic uptick. This marks a pivotal moment in Japan's economic policy narrative, signaling a potential new era of growth and stability. That wraps up our journey through Japan's economic landscape today. Thank you for tuning in. If you found this exploration enlightening or it sparked some new thoughts, I'd love your support. Hit that like button, subscribe for more deep dives, and don't hesitate to join our community with your comments and ideas. Your engagement is what makes this all worthwhile. Ready for more insights? Another video is up next on our channel. Check it out and keep the conversation going. Thanks again, and see you in the next one.